You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back, not on our appointed rounds on Education Wednesday. No, we're doing a little bit of the old switcheroo. We've moved our Pro Q&A from its normal slot on Tuesday to Wednesday, and now we have redubbed Tuesday Education Tuesday, at least for this week, because you're getting a nice hearty dose of Options Bootcamp outside of your normal bat time and your normal bat channel listeners. For all you pro folks who can join us live, it's an extra dose of Options Bootcamp in your life because we love you folks over there on the live side. Of course, all you on-demand folks, it'll be hitting the network post-haste out there, so enjoy that. Speaking of the network, if you do enjoy what you hear, either for Options Bootcamp or for the full network, and quite frankly, you should be listening to the full network by now. You're missing out on a whole bunch of other great options content, carving up the space in a whole bunch of different ways. So crypto derivatives, check, we got that. Volatility, check, we got that. Active retail trading and unusual activity, check and check. Futures options, check. Financial advisors and asset managers, check. You name it. We got something about it here on the network. So be sure to dive in, enjoy, have a good time. If you like what you hear, throw some stars our way. It does help new folks continue to discover the content. And man, there are a lot of new people out there every day. You might say, who's left to discover these options things? Apparently, a lot of new people. They're coming in every day, listeners. Help them find a path. Leave a review. And then, of course, if you want to go above and beyond, you want to join us for the aforementioned Pro Q&A. We just did Pro Q&A 100 last week with our buddy, Mr. Matt Amberson from Oratz. So actually, it was during our Education Wednesday. So we got to make Education Wednesday live and open to everybody as well, which was fun. So hopefully you enjoyed that. That episode is actually in the network feed. So you can get Pro Q&A 100 if you're just an on-demand listener right now. Check it out for yourselves. All sorts of fun, 99 other episodes waiting there for you, as well as, of course, almost 100 options out of these episodes, all kinds of new release stuff up there for you. And coming up, man, it's already almost June. Got to give away another pro trading crate. You guys are going to bankrupt me on all the pro goodies we're sending out to you every month. TheOptionsInsider.com/pro is the place to go to learn more. As I am joined once again on this episode by the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. And man, have you seen shipping rates? I don't know what I was thinking with this pro trading crate, sir. I'm going to bankrupt myself.
Everything's more expensive these days, Mark. It's it's the old inflation thing.
What is this inflation you're speaking of? I've never heard of it, sir.
Yeah. It's a thing. Google it.
It is.
Chat GPT it.
It is a thing indeed. You know what else is a thing, Dan? Usually we bury it till the end of the show. Let people wait for it. We're not going to bury the lead anymore. A lot of people are here for the much anticipated Market Taker question of the week. So we won't make them wait any longer, sir. Dan, what is your question of the week?
Yeah, so somebody asked me this like a week and a half ago, and it got me thinking. The question is, how do I get started as a professional trader? And it's a lot different these days than it was back in, back when we were budding newbies in this business, Mark. I mean, I started literally by knocking on every door of the Chicago Board of Trade building, but you can't really do that anymore. It's so dispersed and decentralized. So, one of the things to do now is to use the power of the internet and start Googling professional trading firms. And, you really have to comb through a lot of baloney to get to the real deal. But sending in the good old fashioned resume, maybe doing some networking. I mean, geez, you can probably take a similar approach to, what I did by just moving to Chicago or New York and getting a job in the financial districts of either place, working anywhere as a barista at a Starbucks and try and make some connections. But yeah, it's a little harder. You have to kind of do it the more traditional way now. But like I said, when I was asked this question a couple of weeks ago, it got me thinking. And so I am going to do a special interview today, sort of like a rare, just sort of talking about my career and the career of our listeners, like what steps that they can take. And I'm going to do that interview today at 3:30 Central Time, 4:30 Eastern. And if anybody wants to attend it, they can just go to markettaker.com/reg, as in register, for the interview. And it's free, and I'll be talking, and you could maybe submit some questions. And it's something new we're trying, so we'd love to see you.
It's funny. You're right, because back in the day, you're right. You came to Chicago and you saw who was hiring, right? You saw who was looking for assistant traders and who would be willing to train you up. And you had to go through a little bit of rigmarole, had to jump through a few hoops. You usually had to eat it on the front end in terms of salary. They weren't paying you a lot to come be a clerk because they knew they had a lot of people beating down their door for that job. And also they knew if you played your cards right, you'd be making money in the long run. So they didn't need to pay you a lot up front. So you had to eat it in terms of starting salary in the beginning. But there was a trajectory you could do pretty clearly, pretty easily. There were a lot of firms here in the Chicago area, you name it, your Susquehannas, your Wolverines, some of the ones I traded for and others that had actual training programs. You could come in, you rotated to this and that. And by the time you were done, you were ready to go as a full-time trader. They would put you on a badge. They would back you, all sorts of fun. Yeah, that path doesn't really exist anymore. That said, Dan, there are interesting hotspots. I was down at the OIC conference a few weeks ago, and I ran into someone who was at a prop firm that I had never heard of, A. B, was out of New Jersey, which is not a known bastion of prop trading in the options world. And C, according to them, had over 100 employees, 100 traders under their employ. So, the universe of places you could go to make money as a quote-unquote professional trader has expanded. It doesn't have to just be Chicago anymore. So if you want to look at for some trading firm, maybe there is one in your area or near you, whereas in the past, that would not have been the case. So on the one hand, it's more difficult. On the other hand, there has been a diaspora of interest in this space and firms looking to compete in this space. Man, it's all server-based upstairs now anyway. You can literally do it from anywhere. So that has opened the doors to new people, and also people who never in the past would have even considered dealing with what you and I dealt with, Dan, right? Which was going down to the floor, having to butt heads against D1 linemen to try to get a spot in the SPX and, all sorts of fun like that. Let's just say that limited the crowd to a select few. And these days, those doors have been opened to a more broad audience. So it's interesting. That said, if you are intrigued by all the quote-unquote trading floor stuff, I will be doing the Option Block show this Thursday live from right above, looking over, actually, the new SIBO trading floor. I haven't checked it out. Dan, you and I have been to the SIBO a bunch of times. I haven't been down to their new trading floor yet. Have you?
I have, yeah. And man, it is fantastic. I mean, it's pretty. I mean, it's like,
yeah, isn't that a weird thing to say? A trading floor is pretty. Those two words should not go together in the same sentence. I was joking with some of the SIBO folks. It's like, no, this is all wrong. This should be dark and oppressive and a place you hold your nose and you go, but it's like you're descending into the abyss. No one wants to go there. And now it's light and cheerful and pleasant. I was talking, the MIAX folks are talking about opening a new floor in Miami. They're going to get some takers just because of the fact that it's in Miami. And they're saying people are asking for a Starbucks on the floor and all kinds of stuff. I was like, what is happening? What is going on with the world here? But yeah, these are the times we live in, Dan. So listeners, if you're intrigued by that, maybe stay tuned to the option block on Thursday, where we'll get into a little bit, maybe get a little bit of some of that trading floor flavor onto that show. I'll be doing that with our buddy, the Flow Master over there, Mr. Henry Schwartz. So that should be fun. You know what else is fun, listeners? It's our basic training. So let's get to it.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, you're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, pull in, prepare to learn. Yes,
All right, listeners, it is time for our basic training. And, you know, Dan kind of gave a little bit of a spoiler on our last episode when we talked about what he thought would be a good topic for the show. He was right. It would be a good topic for the show. It's actually a question we've received quite a bit over the years. Not something we've actually specifically addressed here on the show. We've obviously talked about different ways you could approach this and you could apply it to this specific scenario, but we've never actually talked about it in these terms before, which is, of course, let's say you're out there, you're a typical investor, and you have a bunch of stocks in your portfolio, which most people do. Now you look at it and you say, you know, I'm a little nervous. Maybe the debt ceiling has you spooked. Maybe you just think we're overbid. We're due for a correction out there. Whatever the case may be, something has you a little bit concerned about the future of that portfolio. Now, if you were just long a ton of SPY or SPX, you could just go out and buy some SPY or SPX puts or put spreads or collars and call it a day. You've done your due diligence. You've hedged yourself. You could also, if you wanted, do stock substitution or just sell the thing outright. You have a lot of different options, pun intended, in that environment. But what do you do, Mr. Dan? What do you do if you have a nice portfolio, a broad-based portfolio with a bunch of different stocks, and you want to hedge it, Dan? You know, I'd imagine you get this question quite a bit over there at MTM these days. So when someone comes into you, they ring your bell down there in Frankfurt, they take their hat in hand, and they say, please, sir, how do I hedge my broad-based portfolio using options? What do you tell them?
I do get this question now and then. And, you know, I mean, a lot of the time I get this from one-on-one coaching students. Because, you know, if you're asking this question, you probably have a big enough portfolio and it probably needs to be somewhat personalized. But I do cover it in like our Trade Smart workshop as well. And so here's our listeners should be able to sort of personalize these as needed. So, okay. The first thing you have to do is get some sort of a sense of, is there an ETF or holder or, you know, some sort of ETN or whatever that matches somewhat your portfolio. And if you have like a really big portfolio with a pretty broad number of stocks, that could be something like the S&P 500, and there's many choices for trading that or using options on that. Could be the Dow Jones Industrial Average if you're doing some of these big name brand stocks. If you're pretty tech heavy, it could be the NASDAQ. You know, you do a lot of energy companies. It could be, you know, like the oil services holder or something like that, OIH. So, and it could be a combination of these too, right? If you have a pretty broad-based portfolio, but maybe it's overweighted in oil companies or energy companies, could be a combination of the two. So the next thing we need to do is look at sizing, right? And the best way to do that is to look at what we call the notional value compared with the value of your portfolio. So like the S&P 500 as measured by let's start with the full size. So the SPX is the S&P 500, right? So that is trading at 4,173.90 as we speak right now live. For those of you who are listening to this live on whatever day it is, Tuesday, May 23rd, 2023. So a little over 4,000. Now, these are options. Each option represents 100 shares of stock. So we're talking about like $417,000 that each one option represents. So if you have $417,000 all sort of tied up in, very, very diversified, you might be able to get away with hedging that with one SPX option. If you have $800,000, you might be able to get away with that by hedging that with two SPX options. And we'll get to exactly how to hedge in a minute. I'm kind of doing a little bit of a soliloquy here. I hope Mark doesn't mind me sort of just diving in here a bit.
I'm deeply offended, sir. But if you must insist, then I'll allow it this time. Just once.
All right, thanks. Now, one other thing here, what happens if you have $200,000 or $100,000 or $600,000 or $1 million, right? It doesn't match up with an exact even 400K, right? Then you probably want to use something like SPY, which is 1/10 the size, so trading around 417-ish right now. $417 right now. And so that ends up coming out to just like $40,000, right? So then we can easily do units of $40,000. And you can make the same case for, diamonds, DIA or DJX. DJX, of course, is the full size Dow. DIA is the smaller size Dow. NASDAQ, if you're really into smaller cap, IWM, which of course is the Russell 2000, or the full size RUT, right? So that's kind of how we do some of the sizing. Now, of course, the obvious question, which is probably what you were asking originally, listeners, but I had to kind of cover some of that stuff that maybe people don't think through first. Exactly how do I do it? And that, my friends, is the trickier part. So you read your first options textbook and they say, hey, if you want to hedge a long stock position, buy a put. And yep, it's simple, it's straightforward, it's clean. The problem is it doesn't really work. Because if you look at, let's just look at some SPX. Let's look at SPY. So I'm pulling up the data here on my platform. If I wanted to hedge for the next 60 days by buying an at-the-money put in SPY, actually, technically, it's a 59-day option. Those would cost me $9 on a $417 underlying. So 60 days is 2 months. That cost me 2%. There are 6 2-month periods in a year. If I were to be completely hedged with that put for an entire year, rolling every 2 months, I'm going to lose 12%, a little over 12%. So considering that the S&P 500 is thought to go up on average 8% a year, 8 to 10%, people quote different measurements for that. That's a losing proposition. It just simply, it doesn't work, right? So we need to have a way to not spend more than we're likely to make on average. And you can do that a number of ways. I don't know. I mean, Mark, do you want to jump in and we can kind of go back and forth on some different ways, or you just want me to continue my Hamlet-esque soliloquy here?
Yes, you are looking at the skull in your hands, alas, poor Yorick, sir. Well, it's interesting because I just kind of laid out some ways at the top of the show, right? There's the standard way you mentioned. You can buy the put, which all the options textbooks tell you to do. And then everyone looks at the options chain and they say, oh my God, no. In fact, we got a question here about Apple. I was just doing that for Apple. It's coming up on the next episode. And you're like, oh my God, no, I don't buy those at the money puts. So yes, that's the first, I think, the comeuppance everyone has. So they may want to hedge their broad-based portfolio, but they don't want to go about it in that route. So then you start looking at a little bit farther out of the money puts. Then, of course, you do the put spread, getting that kicker against it. And then even then, you're still maybe shelling out a level that might be uncomfortable for you. So then you have to start looking at maybe other legs like the collar. And again, I don't want to give away too much of what we're going to talk about on the next episode either here. But that, again, comes back to your personal preference. And some people might say, if I'm going to sell the upside, then maybe I don't even want to hold the position to begin with, because the whole reason I'm doing all this is to maintain some upside. If I'm that concerned about downside, maybe in your scenario, you have this crazy broad-based portfolio and you're that concerned about a lot of downside where you're doing all these things to pay for this downside, then maybe it is time to dial back the position a little bit or perhaps divest of it entirely. Now, obviously, there are tax consequences to that, but there are a lot of different ways to go. And I don't want to put words in your mouth, Dan. I'm assuming you're going to start with the old put spread and work from there, sir?
Yeah, I mean, the put spread. Well, I mean, look, there's a few ways. I would start with one simpler than that first, and just say, pick your spots. Try and time it. But that is a little bit of a fool's errand. I mean, there are definitely some people out there who are better than average at market timing and such, but the more you dive into how markets work and try and approach it from a more of a statistical based endeavor, people will say that you really just can't time the market, because you're going to get these black swans, which are the exact things that you want to hedge against. The times when you expect the market to go, to fall is when everybody expects it to fall. So the puts are more expensive then, and that messes up the system. So I would go as far as saying that I don't know if that's a great way to do it. That being said, I won't 100% rule it out, but we might look at other ways. So another thing that a lot of people talk about is the put spread. Instead of just buying a put and then selling a lower strike put. And there are some benefits and challenges with that as well. The benefit is what I pay for the put, I'm offsetting some of that by selling another put. So like, let's see here. If I were to buy this, let's pull up some data here. If I were to buy that said 59-day at the money put that I was talking about for $9, and then I sell one 12 bucks lower, so 404, I would take in $6 on that. So I'm really only paying $3 for the hedge, which is a lot more attractive. But, the problem is 12 bucks lower, you're only hedging the first 3% move, right? So it's not a super attractive hedge. Now, I mean, we could, we could go sell one even further out of the money. So maybe a $24 lower, which would be, let me see. Man, I remember when we used to be able to do math really fast in our head, Mark.
Part of the job description.
Yes. So that would be the 392 ones, but still, I mean, you're only hedging the first 6% move, the reason why, I mean, I would say even a 6% move is just something that you can kind of ride out over time, It would be nice if We always made money when the market goes up and never lose money when the market goes down. But, that's really not how this game works. So then we would move on to the collar, which you referenced, but I like to use a derivative of the collar. And I don't know how we're doing on time. It's a little bit of an explanation. That could be a whole nother show, really. But
let's get into it. Let's give the people what they're looking for. So what they're paying $0 for.
Yeah, exactly. Yeah. So, a collar is a really nice way to finance that put without giving up any downside protection. You own the put, and there's no truncated insurance. Market falls 20%, you're hedged, you're fine. What you give up, because you always have to give something up, what you give up is potentially some upside. So instead of selling a put against your long put, you're selling a call against your long put. Now, when I say against your long put, that sounds kind of weird because you've got a negative delta put and then you're adding a negative delta call. So in a lot of ways, it kind of protects you even more to the downside because the delta of your protection goes up. It gets closer to a 1-to-1 ratio. But that hurts to the upside too, because you lose closer to a 1-to-1 ratio. Now, all that being said, when I do one-on-one coaching and we go over this sort of thing, a very specific plan for individuals, I like to use what I call the split time collar, which is basically we buy a somewhat longer term put. We don't want to go too long term, but maybe 2 to 6 months. And then we might sell like a 2, 3, or 4 week call against it and really watch that call like a hawk. And if the market starts going up, then we're gonna roll it and we're gonna treat it really just like a covered call. A covered call is something that I've done a great deal of work with. That's one of our main classes for options investors as opposed to traders. And how that ends up working is, you don't really get that. In the long run, you're not going to finance the entire cost of that put, like you would think by reading textbooks. But you're going to offset maybe half of it, kind of like we were able to do by selling another put that's 6% out of the money. But here, we don't have the put truncating our protection. We have just the call to worry about. And, if we watch it and we roll it and we treat it smart and we do our adjustments, then it can be really, really massively beneficial. But, that makes it like a collar in a textbook is a very, very passive thing. You put the collar on and you forget it for 6 months and you come back and you see what happened. The split time collar is not that. It's you put it on, you watch it, you manage that call with some skill, and that's how you play that.
Sounds like the bluebird on your shoulder is enjoying the talk of split time collars, sir.
Oh yeah, it's the birds and the carpenter bees. I'm at our place in Michigan. Sitting outside.
Are you out in the great hinterlands, the great wilderness, recording the show today, sir?
Yeah, I kind of am, man. So I got a bird's nest right behind me. I got these bees that come, like these carpenter bees. They're these gigantic things. Like they don't sting apparently, but they sure buzz loud and they look intimidating if you're not familiar with them.
Dan the Woodsman here, in between talk of split time collars. Well, that's going to do it for this episode. We kind of gave you a good taste of some approaches for hedging broad-based portfolio. I have a feeling this is another topic we'll probably have to revisit. I'm assuming we'll get a bunch of questions on this. How do I do it with this allocation or this ratio of these particular stocks, or how do you like this strategy with it? So if you have questions along these lines, and of course, if you're listening live, I see some of your questions and comments already filtering in. Don't worry, stay tuned. We'll be back instantaneously with another episode for you folks to vent your spleens, get all your questions answered on all things options. Should be fun, a little bit of the old mail call palooza. But before we go, Mr. Dan, if folks want to check out everything you got cooking, maybe they want to come to your place out in the hinterlands and ring the bell, hat in hand, and say, please, sir, how do I hedge my broad-based portfolio using options? I don't know why they all have to be British children, but apparently they are. Where should they go? What should they do?
The British children make better orphans. I mean, it's well documented. They should. I'll tell you what. Attend the interview session that we're having tonight. I think you'll really enjoy it. If you like listening to me ramble on incessantly, you get a full hour of that. So, and you can go there by going to markettaker.com/REG and register for this complimentary, kind of rare interview opportunity.
Cool. And that stuff's all archived, right? Because we get a lot of people coming in weeks, months, even years down the road. I see the data. They can go check that out down the road at MTM as well.
We're going to be a little, not really that far down the road. We will offer up the recording to people who register for the live one. So even if you can't make it at 4:30 Eastern today, register anyway, and you'll get the recording. And we'll probably keep the recording up for about a week. So it is a little bit time.
A week, man. We're all about like decades long audio here on the network. All right, listeners. You got a week. Get in gear over there. MarketTaker.com is the place to go. We got to get out of here. Luckily for all you live folks, we'll be back instantaneously in your ear holes. Another great OBC waiting for you right now. For all you on-demand folks, we'll be back again next week. Another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.